Hello, investors. It is again that time of the year when all of us think about tax saving in a serious manner. And even traditionally, when we look at tax saving, the equity linked saving schemes have proven to be a fairly good tool in terms of obtaining reasonable returns. At the same time, you to get a good tax saving. So one of the feature which sets apart ELSS fund in this tax saving, among other tax saving instruments, is your ability to compound returns without the tax incident being hit until you redeem those funds. So while there are a lot of videos and presentations on how to spot an ELSS fund, so very often we have seen investors focusing too much on the return part while giving very little attention to the risk matrices underlying those funds. So in this video, I'll speak about how to evaluate the funds on a risk adjusted basis. So some of the popular risk metrics which could be used to gauge the risk management practices of a fund, they are the standard deviation kinds of indicate the kind of volatility a fund would go through. So a fund with fairly low standard deviation or low volatility would ensure that over long term, even if you have a fairly balanced performance, there is a very high chance that the fund could make sense on a risk adjusted basis. So even if you back slightly lower returns than the top performing fund, since you are assuming that return with a much lower risk profile, it makes sense from a risk adjusted basis. So another popular metric which investors can use is the Sharpe ratio. The Sharpe ratio kind of indicates the excess return which you are earning over the benchmark per unit of risk which the investor assumes. So if you score a Sharpe ratio more than 1, it indicates that for the extent of risk you are assuming, the excess return which you are bagging is on a positive side. So other popular metric which you can use is the market beta or the fund's beta relative to the indices. So what this kind of indicates is if your fund has a beta of more than 1, which means when the stock market moves up, the fund tends to capture more than what the fund for the what the index kind of performs. For instance, in this table, so we have depicted two scenarios when one is an aggressive fund and the other is a conservative fund. And most likely the possible beta of the aggressive fund would be more than 1. And in case of this conservative fund, most likely the beta would be less than 1. So what typically happens is when a market, let's say in this example, when the market moves up by 60%, the aggressive fund moves more than the markets on the positive trajectory at about 66%, whereas the conservative fund tends to move on a lower side. It underperforms the markets in the year 1. So what happens in year 2 is when, let's assume the market goes through a big downturn, the aggressive fund, it turns to overshoot even on that downside basis. Whereas the conservative funds, it falls lower than the market. So at the end of year 2, if you were to look at the compounded annual growth rate, the conservative fund, which fell less in the second year, scores much better on a 2-year combined basis. This could be simulative of how your fund could perform. So if it assumes very high risk or a low risk over long periods of time. While the fund may not be exciting during bull markets, as market goes through correction phase or as volatility increases, it tends to catch up to a higher extent. So if we want to look at how the quantum ELSS tax saver fund controls such risk, or how we have built in certain risk management practices while designing the fund, so you can appreciate how this outcome could be achieved. So if you look at quantum ELSS tax saver fund, there are three primary matrices where we kind of ensure that the fund does not fund has a very contained kind of risk matrices. One, there is very high regards for valuation. So as and when the underlying stocks breaches the fair value estimate, which we do from fundamental analysis, we tend to start trimming that stock. So while avoiding pockets of overvaluation in a market correction phase, that can help in terms of better downside protection. The second important pillar in which the fund is built is its trust on governance. So with decades of experience in the market, so we have instituted an integrity filter which weeds out all the bad actors. So corporates which have a history of treating minority shareholders in a bad manner, or has a history of shortchanging minority shareholders, will not pass this integrity filter. And therefore, what is left out after the integrity filter is a list of corporates or companies which has a history of treating minority shareholders in a good fashion. So the risk of getting into a company with bad governance is most likely when this governance, the risk kind of manifests, an investor may not get time to exit the company at a reasonable valuation. The other important risk mitigation filter which we employ is the liquidity filter, where we ensure that at the time of initiating the position, the stock trades at a minimum average daily turnover of at least $1 million. When converted to rupee terms, it is about 8.5 crore on a daily basis. So what this helps in terms of the portfolio construction is, one, the portfolio would be built of a set of liquid names. So even in times of market stress, these liquid names may not see the kind of drawdown which an illiquid stock would see, or something which is thinly traded, because there could be more sellers and few buyers at that point in time. And therefore, it's very much possible that such names could see large drawdowns. The second advantage is you would be able to build a scalable portfolio. So even if this fund were to grow multi-folds in the future, since we hold liquid names in the portfolio, we would be able to replicate this performance over long periods of time. So for instance, we keep evaluating a scenario where if we were to replicate this portfolio for a 10,000 crore, 20,000 crore, even upwards, so how much percentage of the underlying stocks can be replicated in that portfolio? And with the current liquidity levels in the market, that estimate is more than 70,000 crore at very conservative estimates in terms of participating in the market. So generally what we assume is we would not engage more than 25% of the holding period as by entering or exiting a stock, and we will not assume a participation of not more than 1/3 of the trading volume in a particular day. So by embedding all these all these practices, what we ensure is we get a portfolio which may not be hit by all the headline risk which you would have typically seen in the historic periods. And while doing all these, we ensure that we have a long-term focus and we invest based on the long-term business trajectory. And most often it is the long-term patterns are easier to identify and replicate over long periods of time. So if a fund manager tends to bet on too many short-term patterns or short-term horizon ideas, the risk is that you may not be able to replicate that over long periods of time. There could be bouts of successes, but those may not be replicated over long periods of time. Especially in an ELSS fund where you lock in your capital for at least 3 years, it is important that your fund manager has a long horizon, long investment horizon. And how, as an investor, you could verify that is by the portfolio turnover ratio. So we generally tend to have a portfolio turnover ratio of less than 20%, which means on an average, we at least hold the stocks for a period of 5 years. So these are some of the metrics which I wanted to discuss with you. And while you choose your ELSS fund, be cognizant of these risks and select a fund where you would have risk adjusted performance. Thank you for patiently listening and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.